to Tech with Heart. I am your host, Michelle Calloway, founder and CEO of Revelio. The Tech with Heart show is all about empowering entrepreneurs to embrace technology so that you can stay competitive and relevant in a rapidly changing digital environment. And today's topic is how you can attract a venture capital investor. And so with me today, we have a very special guest of someone who knows a lot about this topic. His name is Tushar Kansal. He is an investor advisor who has helped many young companies get the funding for many different diverse sectors, such as fintech, edtech, agritech, even consumer B2C and B2B, and disruptive and deep tech, as well as many non-tech sectors. He's from Harvard graduate, and he's got 20 years experience in venture capital and is the CEO and founder of his own Kansaltancy Ventures. So I would like to welcome to the Tech with Heart stage, Tushar.
Hi, Michelle. Hi, thank you so much for having me on your show, and especially discussing something like technology, which is such a core subject for everyone in today's lives, with the advent of the smartphone and with the advent of so much technology which is being absorbed all around us. So, it's my pleasure to be on your show today. And, your smile is infectious. And, I look forward to having a great discussion about this very important subject today. Thank you so much.
I'm very passionate too, Tushar, about supporting innovation. And so venture capitalists, venture capital investors are a humongous part of supporting innovation. So can you share a little bit right out the gate about what is venture capital and how is it different from other types of capital or investment funding?
Sure, that's a very good question. So basically, venture capital is a capital which is very patient. It can wait for 3 years, 5 years, even 8 or 9 years. It is a capital which goes into the riskiest kind of asset, which is startups, because startups are, they don't have anything to show, they are just creating something which they believe will turn out to be very innovative and will, turn out to be disruptive. And that's what investors are looking for. They are looking for disruptive technologies, disruptive processes, disruptive way of thinking, and getting these established, companies who have a comfort zone, getting them out of the market and out competing them. And the role of technology in disrupting this entire ecosystem around sectors has increased to such a level that in today's times, no venture capitalist can think of not having a component of technology in whichever sector he's investing in and whichever company he's investing in. And technology has touched our lives much more in positive way than there are some negatives as well. But end of the day, it has improved our life, improved lifespans, improve the standard of living. And the phenomena of technology marching towards our homes started from dot-com boom in 1999, and then from 2008 Lehman crisis till today COVID. The march of technology is going on, and it's unstoppable.
So can you explain the difference between a venture capital funding versus like angels or seed funding? Help us that don't know a lot about the investment space understand the difference so that we can then go on to like helping us to understand how to attract a venture capitalist and why would we want to attract a venture capitalist versus, is there a difference between them and angels?
Sure. So when an angel investor puts in money, it is his own money, and he's not so much bothered about the process by which he selects companies to invest in. He's more bothered about finding the right founders and backing the right founders. His money might be earned from his business or his salary job, but a venture capitalist, he operates within the confines of the laws of the country, and he raises funds from external investors. These external investors are called limited partners, LPs, and the LPs give their money to the VC fund guys the person who's responsible for investing that money and generating a good return. In our terms, we call it internal rate of return, IRR. The GP, general partner, is supposed to invest that money, generate the promised internal rate of return, and then get exits from the companies and give the money back to the limited partners. And
So they're like
so
the money, so they're like the money manager. So like a VC,
hey,
it's
there
kind
you
of like
go.
they take a pool, they pool their monies together from different investors. Like maybe you're the leader of a VC fund, and then you're going to say, hey, I got a really hot one. You're going to want to get in on this, right? So you go and talk to your investor friends, pool the money, and then you're also the one that manages the process and the exit. Is that what you're saying?
Yeah, absolutely. I mean, just think of it. Sequoia Capital is a fairly known name in the VC community. And one of the funds which it raised invested $50 million in WhatsApp. And within a span of 3 to 4 years, it sold WhatsApp for $19 billion. So from a $50 million investment to a company which is valued at $19 billion. So when we talk of venture capital funding, we are talking about returns which are astronomically high than the money which has been invested. So that is the charm about venture capital. It chases returns and generates outsized returns if the GP or the general partner is smart enough in his investments. Uh, 7 out of 10 companies in which the VC puts in the money close down, but they have a portfolio approach, so they are always looking for those 1 or 2 companies out of the 10 which outperform the market, and which get a valuation of more than 200 to 300 times the value at which the VC invested. So, as an asset class, the venture capital class is very, good in getting returns, and the role of technology cannot be understated. This kind of scalability which the startups get, a huge part of that, it is because of they use technology to scale.
Exactly. I'm so glad that you clarified that. Thank you so much for helping us. Those of us who aren't in your space kind of bring it down to like a fourth grader level. So I appreciate that. So when you are a company and you could use some VC funding, like what are some things for the companies to keep in mind when we start seeking some venture capitalist funding?
Uh, Thank you for that question. It's a very good question. So basically, you have to keep in mind that you should be solving some problem for the humanity, which is a big problem. So the bigger problem you solve, the more uh, chances there are that you will end up creating something which is totally disruptive, which is totally new. And I'll give you an example. There's a classmate of mine from my engineering days. This guy saw that the Coke and Pepsi and these consumer companies, they don't recycle the plastic bottles, the PET bottles, and they are left to the environment. So this guy created a business model in which these companies collected used bottles and delivered it at his factory. And in the factory, he had a waste management unit. And now the turnover which this guy does is, within a matter of 6 years, he's already doing a turnover of $25 million. And he solved a major problem which people faced, the environment getting affected. And he used the solutions which were already available, but he used it very wisely. He created a value proposition for each stakeholder, for the bottler, for the company, the drink company, for the customer, and for the government, the municipal corporations. He created value for all of them in such a brilliant way that he ended up having a $25 million turnover company with a huge amount of gross margin over there. And so, apart from the problem and the solution, the team is very important. The team has to be very balanced. They should have people from all across specialities like products, and then marketing, and then finance and technology. And it doesn't matter that whether all of them are co-founders. They can be working on a salary, but maybe having some shares from the company, because startups typically are not able to pay that much, so they give shares of their companies as well, which are called ESOPs, employee stock option plans. And then the business model around the product which they have created is very important, as to how will this product make money. And then we talk about investor wanting to know what is your current traction, how much business are you doing right now, and whether you have proved that your product has the capacity to generate money from the customer. Because 60% of the startups closed down because they created a product which did not find a customer. So it's very important that you show some traction to the VC, and then who are your competitors, and what are your competitive advantages as compared to those competitors.
Being able to do business online is crucial for survival, especially during times of social distancing. So how do you survive and thrive in the sea of digital noise? It's a lot like fishing. You need to know who your perfect customer is so that you can use the right kind of lure to attract them. We help you catch your perfect customer and retain them for future sales through highly converting websites, influencer mobile apps, getting you featured in the news and on TV. Hi, my name is Jerry Bowden, U.S. Army veteran and president of Revelio Software Solutions. Our goal is to help you rise above the competition, be seen as an expert authority in your industry, and embrace technology to stay competitive for long-term success. It's more affordable than you may think. So reach out to us at revelio.com, and together we will make your business come alive.
And let me just interject here for a minute, please. I just want to make sure that we have clarity when it comes to, you're saying a lot of, you want to see traction. That makes sense. You want to see viability in the business plan and the team, because you want to know that moving forward, the team is equipped to handle all the different levels of growth and momentum. But when it comes to getting to that phase, oftentimes startups will need funding just to get to that phase, like to build a prototype or to test the market or whatnot. And so is that where angels come in and VCs come a little later in the growth plan?
So that's a very good question, because usually initially the investors which come in, they come in after the founders have created something by maybe using the money from friends and family. And if not from friends and family, maybe raising a small amount of money from accelerators and incubators, which fund a small amount and help you in the ecosystem. And
Okay, thanks
we
for
see,
that clarity. That's good. That's
yeah,
good stuff. Yeah.
thank you. So what is happening is we are seeing a new trend. The trend is that although VCs came in after the product was established, after certain parameters were completed, like the product market fit was achieved, but now we are seeing a trend of VCs investing early. So they have specific products for early stage investing. They feel that even if early stage investing is very risky, but deploying their know-how and specialization on early stage startups, they can get some very good deals and support some very good companies. So there is a trend of going early.
So let me just ask you a few more questions in this little part of the meat, where the rubber meets the road kind of a thing. So when a startup brings to you an idea, and they maybe didn't have the funding that they fully needed to get the full prototype built and operational, but they have been able to present the idea, and it's solving a big problem, that they've gotten some letters of intent from some major players in the space, like you were saying, waste management. Perhaps a letter of intent from the waste management in the country or the city or whatnot would help the startup's case presenting to the VCs right? That this is a viable solution for a big, huge problem, but we didn't get the funding at this point to get this thing fully operational to prove traction in the market. And also, can you speak to that? And then also, what about competitive advantage versus the ability to patent or protect the idea?
Thank you. So basically, see, I'll tell you, you might be a pre-revenue company. You might be pre-seed, pre-revenue. But the point is, the investor will always have a problem giving you a good valuation. And, he will always have a problem giving you good money to back your product because you are pre-revenue. And the best part about the best stage of investing is once revenue has started coming in and things look a little bit more settled. So I'll give you an example of an organic company which has created formulations for men's grooming products, for beauty products, for children products. And their formulations comply with the highest standard available in the market, which is EcoCert Cosmos V3. Excuse me. And this company, they when they came to me, they had letters of interest from 28 distributors, and they had the letter from the EcoCert Cosmos V3 compliant manufacturing company, and they also had a letter from the UAE's biggest distributor, Sara LLC. So we just had to back them up with a small amount of money, and we could see that how early the revenue will start coming in. And similarly, there is a company called 10 Club, which is modeled on the New York based Thrasio, and they had letters of intent worth $15 million when they started looking for funding, and they got a seed capital of $40 million, a seed capital of $40 million. So basically, the amount of work you do to have visibility of cash flow, to have visibility of relationships across the chain, whether it is on the customer side or on the distributor side or on the technology side, it makes it that much more easier for the investor to back you with good amount of money. And
That is a great story. That right there painted a really good picture of the flexibility of the VCs. Like if they see a really great idea and they don't have all of the components, that doesn't mean that they're just absolutely it's out, right? Can you, as we wrap up this interview, can you share with us maybe like the top 3 things that venture capitalists are looking for in order to want to invest into a company? Just 3 things.
Michelle, 3 things. The first one has to be the team. End of the day, even if you are backing a wrong product, if the team is good, they will pivot their business model and change the product to a better product. So end of the day, you are backing horses, and so I would say the team is number one. Secondly, in our terminology, we say product market fit. Product market fit means that whether the distribution strategy, go to market strategy, whether the pricing of different kind of products, all of that has been established or not. And so, I would say that any company with a PMF achieved in a difficult market, and that kind of PMF will really allow an investor like me to invest my money in that company. So the first is the team, second is the PMF, and third, which is often ignored, is the market size. So I don't want to invest in in products which have a small market, because if the market is small, then the company would have to put marketing money for growing the market and not only selling the product. And that would mean a huge amount of cash burn. So there are companies like DOOH companies, digital out of home, and typically that market is a small market, and it has been growing, but it is right now a small market. So we saw a company, we worked very closely with them. but market size was always an issue, and I've seen that how it can impact investment decisions. So these are the three things, Michelle.
That was fabulous. Thank you so much, Tushar. So when somebody wanted to reach out to you to talk to you, or even investors themselves, you advise investors. So where could they go to reach out to you, Tushar?
I can be reached on my LinkedIn. If you search my name, Tushar Kansal, you will see my profile, and the company name is Kansaltancy Ventures. The consultancy starts from my surname. And the other option is through my website, www.consultancy.com. And the third option is you can email me by my initials, tk@consultancy.com, or you could WhatsApp me. My WhatsApp number is there on my website, so you can take it from there.
Perfect. What is a quote or a phrase, just a simple nugget of wisdom that you could leave with anybody that's watching or listening to this interview right now?
I love this quote because this quote is, all these spiritual classics which I read about my religion, and, about the people from all walks of life, and the spiritual gurus, whether from the US or Japan, or they always say that do not try to fix whatever comes in your life. You fix yourself in such a way that whatever comes, you will be fine. So, it is ultimately about we accepting life as it comes, rather than, trying to push and pull, and, trying to somehow have an ideal world in your imagination. So, it's actually, this thing is in a spiritual sense, how to take life. But when it comes to businesses, of course, we dream about new creation, innovation, technology, and that's how things are created if we stay positive and on course to develop that product or service.
Well, that was wonderful. Thank you so much, Tushar. So if you're watching or listening to this Tech with Heart interview today, and you are an expert in your industry, and you have a heart to serve and support innovation and entrepreneurs and small business owners to help them to be successful, especially in a rapidly changing digital environment, we need you to come reach out to us so that I can interview you on this Tech with Heart show, so that together we can elevate and empower entrepreneurs. And then also, if you are an entrepreneur and you want to hang out with very innovative, forward-thinking, but yet heart-centered entrepreneurs, so that you can grow alongside one another and think differently and be led to insights that could potentially just really move that needle, then go to techwithheartnetwork.com. Reach out to us. Welcome to our community. You can join for free, or you can join at a gold level and be elevated as an expert or an influencer in our community. We all need each other. So let's grow together, let's rise together, and let's continue to use Tech with Heart. Here is to your success.